you guys doing? Today I want to talk to you about the Insured Retirement Program. It's a strategy for very few Canadians to use, but if you fit into this category, then it can be a good addition to your retirement plan potentially. So I want to explain it. If you haven't, obviously, please subscribe. We love to have you. If you learn anything, please feel free to reach out if you have any questions about this. I'm going to do my best to just explain the strategy, show you an actual example of one, how it kind of works. Every single human being is different. Every insurance company is different. So this isn't necessarily going to be exactly what yours would look like, and none of the things in here are guaranteed. So please keep that all in mind. You've probably seen out there's a lot of advisors or people with, entire businesses that are like, be your own banker, or, we're going to put on a seminar to show you how to take control of your retirement and do this strategy and blah, blah, blah. And I think that is very dangerous to sell it as something to people in general that they should do, because there are dangers for a lot of typical Canadians who might want to do this, and I'll explain what those are. So this is generally a strategy for two types of people in my estimation, and that's about it. And the first is, professionals that make good money and it's steady and they always make too much money, or you're a business owner and it's the same situation. You have too much money. You need to find a way to, hide some of it from taxes inside of your corporation. And you also know that your income is going to be steady. Because what happens is, if you do one of these, and I see this all the time, they get sold to people because they look absolutely fantastic in years where they make the most money they've ever made in their entire career. And then a few years later, they don't make as much money. And now the first thing to go is this, which ends up costing them a lot of money. You can end up losing. Your insurance agent made a whole bunch of money selling you this product that just wasn't right for you and your situation. So please note that you should never do this unless you're in a situation where, if you're, a salaried employee or whatever, you make good money, you should have your RSPs maxed out, that kind of stuff figured out. And you also want to potentially have a need to create a little bit of an estate plan. So there's going to be two factors involved with this. Now I'll quickly explain how participating whole life insurance works, giving sort of my simplest example of how that works is you buy insurance, but you pay too much money for it. So you're paying for, term insurance, let's say, for example, but then you're also paying too much money, and you've set like an actual time frame of 10 or 20 years that you're going to pay that amount of money for this insurance. And the extra money is going to go into a pool of funds that is managed by the insurance company, and they're going to invest that money. You're not going to see what they're investing in. And what that does every single year is that pays a dividend out to the policyholders, which they set their dividend every single year, and you don't know what it's going to be, but they've never not paid a dividend. But it's not the same as like a dividend that's being paid if you own like a bank stock, because there's other fees and things associated with it. So showing the true rate of return is actually quite difficult. But what that does is then that adds to the cash surrender value of the policy, and it also increases your life insurance benefit over time. So the good thing about this is that that extra money going in there is actually like hidden from the CRA. So it's actually growing tax deferred or potentially tax free inside of there. As those dividends keep paying out, you're not going to get a tax bill every year. So it's kind of like it's growing within your RSP, but you don't see what those investments are. Now, if you keep this for your life and that passes down to your estate, then what that does is it just pays out tax-free to your estate, which is actually a really good way to create sort of an enhanced estate benefit for your family by putting some money into one of these, allowing it to grow tax deferred, and then paying out to your family tax-free. That's why it's great for corporations like myself to say, maybe there's too much money coming in. We don't need all that money to go into our personal hands. I've got an extra, $10,000 that we don't need every year. I could put it into one of these and just allow it to grow. And then when I pass away, that life insurance benefit would basically end up going to my son almost completely tax-free. So it's a way to get that money out of my company almost tax-free. That's why this is better for business owners, but I'm going to try and keep it simple by just showing it as like actual individuals. They're just doing this personally. Now, the other thing that you're allowed to do with these is, so you've got this cash surrender value that's growing. At any point in time, if you wanted, you could take this money out of the policy. You could collapse the policy if you wanted, and you could take this money out and pay tax on it. But that's not actually a very good option, because that's going to cost you tax dollars. You're not going to get the best bang for your buck necessarily. So what these insurance companies do, or generally also kind of banks or financial institutions, is they know that these things are really safe. So they say, we're going to allow you to borrow money against this policy, just like you could potentially borrow money against your house, for example. They're going to allow you to borrow up to 90% of the cash surrender value at any given time. And, you're going to pay interest on the loan. And so what you can do is you can start peeling money out, kind of like a line of credit every year, saying, okay, I'm going to pull out this amount of money to enhance my retirement income, which this is like sort of a tax-free retirement income. You don't have to pay any interest on the loan or make any interest payments. If you don't want, you can if you want, but you can just allow this to build. Okay, so you don't necessarily want to collapse the policy by cashing out the cash surrender value, because now you no longer have that insurance in place. The policy is no longer in place. And worst case scenario is that you do this before it's caught up. So this is what I see happen all the time is people buy them, the premiums are too high. It's generally the first thing to go when, you find yourself in financial difficulty, because you're like, it feels like a big bill, and you don't really see the benefit because this is a long-term game. And this isn't something that is like, oh, I'm going to make money short term. It is part of an overall financial plan that is only a piece, and it should never be a giant piece. And it should be in there for a reason. So you don't want to see anybody have to collapse the policy and take the cash surrender value because they need the money. That means it was sold to the wrong person. So in some cases, what you get to do is you just want this. You don't need the money. You've just put this into this policy. And I talk to retirees about this a little bit. When I say you've got too much money in your non-registered account, one thing we can do to reduce your taxes, increase your estate if you want, and if you're insurable, is to say, let's put, X amount of dollars a year into one of these things, and it will go directly to your beneficiaries. You won't have to pay tax on the growth of that. It's probably better than the fixed income portion of your portfolio. So it is a lot better. It's generally going to pay a lot better than, say, GICs or something. Is quite a bit safer, more tax efficient. Now, that isn't the purpose of the IRP or the Insured Retirement Program. It's generally for younger people putting money in and then wanting to draw an income stream in retirement on top of, RSPs, CPP, OAS, and allows it to be tax efficient because of the way that it's structured. So what happens is you put the money in, eventually you've put in so much money that this policy starts funding itself and just keeps growing. So what happens is the cash surrender value keeps growing, the death benefit keeps growing, and at some point in time, because they know that these things are very safe, because they are very safe investments and their insurance policies, and they know that the death benefit is going to be X, so they are willing to say, you know what, we will actually lend you money against this policy. So they'll look and they say, your cash surrender value is X, we will lend you up to 90% of the value of that, and you can borrow that money however you want, pull that money out tax-free, and just allow that to supplement your retirement income. And you don't actually have to pay back that actual loan if you don't want. You can just allow it to accumulate on itself and just build up interest on top of itself until you end up passing away. Then what happens when you pass away is your life insurance policy was assigned to the lender as like a collateral lender or whatever, where they get, the first payout, and then there's a remaining balance that can end up going to your estate tax-free. So the loan gets paid, the remainder goes to your estate. So what I'm going to do here is I'm going to show you an actual example of, and I should have done this a little bit more simple and done something different, but whatever. I'll show you this one to give you an idea. Generally, people you might see do these types of things are obviously high-earning professionals, right? Doctors, lawyers, whatever. You see them do it a lot. I see them get sold to people a lot of times, sometimes when I don't think that they should have been sold. So I'm generally the type of guy that talks to people about the idea that these are not perfect and there are problems, and other people in the industry just walk in the door and say, this is what you need to do, and are very good at selling them, and that sometimes puts people into trouble. So that's why I don't do it. I want anybody that's going to buy one of these to know exactly what's happening. So what we've got here is a 42-year-old male, and he's married to a 37-year-old female. I wish it was 40 and 40. It would have been easier to look at. And they've got enough money that, they need something to do with the extra. One easy thing you could always do is just invest the extra into any sort of low-cost portfolio, let it build, pay some dividends, whatever, draw an income stream, you'll be fine. However, there are other options. So this could be a portion of, what they might want to think about doing if it suits, their goals. So the recommendation here, or, the illustration says, we're going to put $40,000 a year into this policy for 10 years. So for 10 years, we're going to put $40,000 in each year, the total investment of $400,000 from 42 until 52 years old. In the illustration that I'm going to show, the bank loan rate is going to be 5%. We're going to start pulling money out after the wife turns 65. So actually when she's 66, they're going to take the loan for 23 years at the maximum amount that they can take based on this amount. So that's what we're going to do, is we're going to pull money out from 65 until 88 years old, and see what happens. So, like I said before, what you're doing is you're paying for insurance. In this case, the life insurance that they were paying for on the 10-year term or whatever it was. Actually, it was a paid in 90, but we're just overfunding the hell out of it for 10 years. Would have been $17,000 a year or something to get a permanent insurance policy that you paid for that would pay out at the very beginning about $1.4 million. And that would grow to somewhere around $3.5 million by the time she was 88 years old. So $3.4 million tax-free for $400,000 going in. Now, so they've stopped paying after 10 years, and at her age 66, the cash surrender value is $1,011,738. So if they wanted to, at that point in time, they could go to Manulife Bank and say, we want to borrow $910,564 against this policy, and that's it. That's how much money we want to borrow against it. That's 90%. Hopefully, our loan doesn't catch up so that we actually have to pay back the interest at the end of the day. When we die, then we've taken this money out of this policy tax-free. That's probably not what you're going to do. If you're retired, you just want, an annual income stream. So in this case, what they're going to do is they're going to borrow $55,008 every single year from 65 until 88. So 23 years, they're going to pull $55,000 from this loan, and that's what they're going to do. And at that time, they have borrowed $1,265,184 from this policy to enhance their retirement income. And their outstanding loan balance is pretty significant because they haven't made a single interest payment on this. So their outstanding interest loan balance is $2,392,958. So $2,392,958. So now their cash surrender value is $2,658,876. So they couldn't actually borrow anymore against this policy because that's the point where the loan balance is higher than 90% of the cash surrender value. So you'd have to obviously borrow less if it reaches that point in time. So now what we're looking at here is assuming that this is when the second spouse passes away. So it's a joint last to die, which means that it pays out upon the second death. There are other policies where it's like joint first to die, where it doesn't matter who passes away first, then the spouse gets it. But in this case, it's meant for something completely different. So this time, the death benefit has grown to $3,412,385, and then it's going to pay the outstanding loan balance of $2,392,958, and the net estate value, what is left there, is $1,019,427. So, too long, didn't read or whatever. They put $400,000 into this policy, and at 65 to 88, so she was 37. So from 37 to 47, she put in $40,000 a year, $400,000. At 65, she started borrowing out $55,000 a year until she was 88, and then her family got a little over $1 million in a death benefit. So in comparison to, say, a fixed income investment like earning 3 or 4 or 5% in a GIC or a bond, this is obviously the clear winner. And it really helps you to avoid a lot of taxes. I also believe, obviously, and I've talked about this before, that I think the Canadian government at some point in time is going to be a little bit more serious about starting to tax, larger estates and, taking a wealth tax and whatever, because they're going to need to pay for COVID and all of these other things. A lot of provinces might increase their probate fees, so this is something that can avoid probate as well. So there are definite benefits. The biggest downfall, obviously, is that you cannot afford it. And that's the one thing, is like, this gets sold to people like all the time. And I mean, honestly, it's one of those things that should only be sold to a very small percentage of the population. So that's what bothers me, is if you look at the actual percentage of these things that get sold compared to life insurance policies that get sold, this is super high, because what happens, and I've talked about this a lot, is that we are, compensated very well for selling higher premium life insurance policies, because basically our pay is just set on, we get paid based on the premiums. So it's like, well, if the premiums are $40,000 a year, or if you needed life insurance for $1 million and it was $2,000 a year, well, which one do you think is going to pay me more? So you need to know that. It's something that I obviously talk about whenever I bring this up. It's not like I'm trying to sell this to everybody, but if it fits into your plan, then it might be a good piece of the puzzle. That's it. If you have questions about it, please feel free to reach out to us. If it makes sense, then we might recommend it and show you certain illustrations and examples. If we don't think it makes any sense, we wouldn't even talk to you about it. So, thanks again for watching. Please subscribe if you haven't, and we'll see you very soon.